Condos are a little bit unique when it comes to cost segregation. There's a misconception in the real estate world. Agents always talk about you own the airspace. You're a property manager. You just own a lot of property and that's your full-time job. Then all of a sudden, you can take the depreciation that residential rental property, long-term rental, so anything greater than 30 days, because you're not going to be audited the year that you file your tax return. You're going to get a call in 3 years.
You are entering lifestyle dentist territory where healthy, wealthy, generous dentists choose to live epic lives on their terms with freedom and fulfillment. I'm your host, Dr. Garth Hatch. Buckle up for another exciting episode. Hey, lifestyle investors, very excited for this episode with Brian Kiczula. Brian is an expert in cost segregation studies, investing in real estate, and using that cost segregation as an amazing asset, especially with the new big, beautiful bill. It's a great option with 100% bonus depreciation that business owners and soon to be business owners, if you want to become a business, aside from just your dental practice, there's ways that you can really leverage this strategy using cost segregation studies. Brian is coming from the beautiful Sarasota, Florida. Nice and warm right now. I'm jealous. And so excited for that. And Brian, just to start off, thank you first so much for being here. And why don't you tell us a little bit about yourself?
Yeah, so cost segregation specialist. I live down here in Sarasota, Florida, but really do cost segregation studies across the United States on a wide range of properties, whether you're buying a single family home all the way up to you're converting an old Kmart into a storage facility. So, I've seen a lot of interesting projects and so cost segregation.
That's awesome. That's awesome. I guess just to start off with, what is a cost segregation and how would it be used? Let's say I own my dental building, or I'm getting ready to buy my dental building. I guess for this example, let's say you've owned your dental building for 5 years maybe, but you've never done anything with it. Is it possible to do a cost segregation study even if you've owned it a couple of years, or is it something that you've got to do right away? And how would that look?
Yeah, so I always recommend that you do a cost segregation study in the year that you acquire the property. But the reality is not everybody knows about cost segregation, and not all CPAs, or let's call it a real estate friendly investor CPA, if you will. So the answer is, yeah, you could absolutely do a cost segregation study on a building that you acquired years ago. I've got a client right now who that's exactly what we're doing, is we're going to do a cost segregation study on a property that they acquired back in 2022. It's a medical office. They've got 4 tenants. So we're just going to do a look back study. So we're going to go back in time, and the cool thing about that is you don't have to amend a prior year's tax return to do it. So you're not changing what's already been done. You're going and you're pulling forward the missed depreciation. And you do that using a form called the Form 3115, a change of accounting method. And so I do look back studies all the time.
That's awesome. That's good to hear. And with that, if you are just getting used to, this option, as a dentist, can anybody do a cost segregation study? Do you have to be a real estate professional? How does that work?
Yeah, so I guess we should back up and really, look at, why would you do a cost segregation study? What is a cost segregation study? Just because it's one of those things that I don't think everybody really understands. So the reason why you're doing a cost segregation study is because we're talking about depreciation. When you buy a piece of real estate, it's typically residential is depreciated over 27 and a half years, and commercial is 39 years. So most CPAs will take the basis. Let's say you bought a building for $1 million, and the land allocation, because land is a non-depreciable asset, you have to back that out. Let's call it $200,000, and you're left with an $800,000 basis. So you would then take that $800,000 and depreciate it over 39 years if it's commercial. And you could take that depreciation and it offsets either active or passive income. The reality, though, is the IRS will allow you to carve that building up into different asset classes. So, for example, the first thing that we're going to do is we're going to look at the exterior of your property and look at site improvements. So do you have, a driveway? Do you have sidewalks? Do you have maybe a monument sign? Do you have landscaping? Do you have irrigation lines? What do you really have on your site? Well, the IRS allows you to depreciate those items over 15 years. And then on the interior of the property, whether it's residential or commercial, we're looking at, your business use activity. So what is in that building that is specific to your building use? So if you're talking about a dentist office, you may have a little carve out where you have your x-ray machine, and in the walls, you may have lead sheets that protect the surrounding room. Well, those lead sheets are expensive, and the only reason they're in that property is because of the business use as a dental office. And that would be a 5-year asset. And because of bonus depreciation, you can pull forward all of those assets depending on the tax year, but now they've increased bonus depreciation back up to 100%. So you can pull forward all of those short life assets, the exterior site improvements and the interior improvements that are specific to the business. So then you have this, let's say this large amount of depreciation that you're taking. And then you could use that depreciation to offset either active or passive income. And that's where cost segregation becomes so powerful.
Yeah, it is. From my own journey and studies, I've never seen anything more powerful for legally reducing your tax burden than using bonus depreciation cost segregation studies, in particular with real estate. And on that note, too, just is it only real estate that you can do cost segregation studies? Are there other assets that could have a cost segregation study, or how does that work?
So we only deal with residential and commercial property, so real estate specifically. But sure, I mean, when you're looking at bonus depreciation, there's all sorts of things. So look at your equipment. I know a lot of times equipment is leased. So if you're leasing your equipment, you're not going to be able to accelerate the depreciation on it because you don't own it, but you're taking the expense that you pay every month for that equipment. But if you own the equipment, you can accelerate the depreciation on that, and that would be a 5-year asset. So when we're doing cost segregation studies for clients, I just did a restaurant up in the Blue Ridge Mountains, and we went in, and when they bought the restaurant, they bought everything. So the entire business, all the plates, all the cups, all the silverware. So part of the study was us going in and, analyzing or really looking at all of the assets and doing the cost segregation study. And in that case, we pulled forward all of their equipment as well because they owned it, with the exception of a couple of things that were leased. But yeah.
That's awesome. Can you give an example? Like, just say that first example, somebody just bought their dental building. It's $1 million dental building and standalone box. What might be an average depreciation that they could anticipate? And I know it varies based on the property, on the state, on a lot of different things, but just say some ballpark figures, maybe if it's $1 million dental building.
It's really hard to just throw out ballpark numbers, but I mean, and it's just because every building is so different when you're looking at site improvements, when you're looking at interior improvements. But I've seen, the practice that I just did recently at dentist office, we accelerated, I think it was right at 30% of the total basis. So it's 30% of it. So let's say it was $1 million basis. That's $300,000 in year one of accelerated depreciation. And because the owner was a dentist, it helped offset active incomes, not just the passive income per se, like a standard residential rental property. And that's going to be a big thing to really look at as well. As so when you're doing cost segregation studies and you're accelerating the depreciation, you really have two buckets that you're looking at. It's really non-passive, but I'm going to call it active income and then passive income. But your passive depreciation is never really going to jump over and offset your active income. So let's say you're a W-2 employee and you're strictly doing residential rentals. You're not a real estate professional because you're a dentist. Well, your long-term rentals, that depreciation is not going to jump over and offset your dental income. You're going to cap out as far as what you're making, and it's just not going to offset it. So it's only going to offset passive income in that scenario. But let's say, so clients will say, well, why would you do a cost segregation study on a residential property if it's only offsetting that passive income. Well, the reality is you may need to offset that passive income at some point when your rental properties are generating the income that they're supposed to be generating, or when you sell that property, or when you sell another property, you may need that depreciation. The other real benefit is if you do any improvements to the property in future years, you could take a disposition of the asset that you're removing and then place the new asset in service. So think a roof, windows, door, items that are typically 27 years, or 39 years, you could take the disposition of asset. Now, on the other hand, you have your active income. So let's say you're a dentist, you own the building. You can then possibly, you'd want to talk to your CPA about it because everybody's scenario is a little bit different. You would be able to use that in or depreciation to offset that active income. There's also different, rules when it comes to business uses. So if you owned a Airbnb, that would be, and you were materially participating in that Airbnb, all of a sudden you might be able to take advantage of the short-term rental loophole and use that depreciation to potentially offset other active income. There's definitely rules around that, but that would be, a
Yeah.
use case that we could look at.
Hey, and I want to go into the short-term rental because I think that's an awesome option for a lot of dentists, especially if they don't have a spouse that's considered a real estate professional, or they don't want to become a real estate professional. But with that one example of the dentist, $1 million building, they got $300,000 worth of depreciation from that purchase, and say their income was $300,000 and they were going to owe $100,000 in taxes. But just rough numbers of that $300,000. How would that work with reducing their taxes either that first year or multiple years if they had a $300,000 depreciation from their
Well, that's the beauty
active.
of the depreciation. It's offsetting the income. So it's offsetting dollar for dollar income. So now your
So if they,
tax savings going to
yeah.
depend on your federal tax rate, but yeah, it's going to offset all that income.
So theoretically, they owed $100,000 in federal taxes, and they had a $300,000 deduction. They could basically pay no taxes for the next 3 years, if everything stayed the same in ballpark because of that one property.
Yeah. So what I would do in this scenario, let's say you came to me and you asked that question specifically, what I would say is, send me the property address, the purchase price, your in-service date, if it's current year, or if it was a prior year acquisition, I'd also request your depreciation schedule. I would work up an estimated benefit of doing the cost segregation study, no charge. I would say go ahead and run it by your CPA or your financial advisor, whoever's walking you through this process, to make sure that the savings that you're generating is there. And then, if you wanted to, then move forward. So that's really the step. I wouldn't assume anything. I would just always say, take it back to your CPA, have them plug the numbers in. That way you really know what's going to happen. So it's having that conversation, before the filing deadline. So you know exactly what it looks like.
100% agree with that. And yeah, as anything, verify with your CPA, check with your individual property in your state, everything else, because it can vary. But it just goes to show how powerful that is. Assuming it was an average scenario where the guy was making, say, $300K a year, he owes typically between $60,000 and $100,000 a year in taxes. Just that one building would essentially wipe out his tax burden, his federal tax burden, for several years to come. And that's, yeah, go ahead.
I was going to say another misconception I get is a lot of people say, well, I don't want to take all the depreciation because I won't have any depreciation in future years. And that's just not the case, because we're not accelerating 100% of your building, only accelerating your short life assets. So you're still going to have that other, let's call it 70 to 80% of the building that's being depreciated over 39 years. So you're still going to have that depreciation every single year that comes in, just not on the short life assets.
Well, and that's where I think the strategy is really so powerful, because some people might say, yeah, but investing in real estate, you only get maybe a 3 max 5% return on your investment kind of thing. And yet it's missing the point that there's so many extra levers there with, for one, leverage, which can be good and bad depending on the situation, but you're not buying the $1 million dental building, typically with $1 million, you're usually getting a loan to buy that. And if you're typically paying $100,000 a year in taxes, instead of giving that to Uncle Sam, you're using that to buy an asset that will generate revenue for you as long as you want to own that. I mean, it could be the rest of your life. And so it's such a powerful, and you're getting that right off the bat. Or say it's similar scenario, you're making $800,000 a year as a dentist, and your tax burden was going to be $200,000-$300,000. Instead of writing a check for your federal taxes, you could essentially eliminate that and use that money to invest in other things. I mean, that's why it's just such a powerful strategy. And
Yeah, I see clients all the time that they'll come in and, they'll sell their practice and they'll keep the real estate and still generate the rental income. I
Mhm.
mean, real estate, is it's the ideal investment. It's an acronym for you can generate income, you have depreciation, you can have equity in the property, you have appreciation, and you have leverage. So, there's no doubt that real estate is a good opportunity.
Yeah, yeah, I totally agree. For most dentists, our biggest expense is taxes. And if we can find a way to legally invest in ourselves and do it where we are helping the economy, we are helping provide jobs. If you're buying a short-term rental, you're providing a service for people that may need to rent a property short-term or for vacation or for work or whatever else. So you are adding value, and that's why those tax incentives are there. I like Robert Kiyosaki's tax guy, Tom Wheelwright. I've worked with him in the past, and he is big on, if you want to change your tax, you need to change your facts. And so if you can invest in a tax advantage strategy that's legal, that's in the code, not even questionable, not gray area. I mean, it's totally above board. It's totally legal, and for a good reason, because it's essentially it's an incentive of the government for people to invest in businesses, invest in real estate, to provide jobs, to provide housing. Those are things that our economy needs and the country needs. And so because of that, you're very well rewarded for doing that investment. So yeah, it's such a powerful strategy.
And when you're talking about, businesses, I think that's really the key difference between that active income versus the passive. And it's just one of these things with residential real estate. They kind of carved out it's in its own bucket, if you will. So when we're looking at short-term rentals, it doesn't have to be a short-term rental. The key is that you're materially participating in a business that you own. So people will tend to gravitate towards short-term rentals, but I've got clients that went the other way. They started buying storage facilities or RV parks or restaurants. So they're buying these businesses that they can accelerate the depreciation on. They are materially participating in that business. So it's the business use is what we're looking at.
That makes sense. Can you go through, because I think for a lot of dentists, if they say they already own their building, they've done the cost seg, or they don't want to open another location, but they would like to start taking advantage of bonus depreciation of cost seg, and their spouse does not qualify as a real estate professional or doesn't want to qualify as a real estate professional. With the short-term rental, what would that look like? Say you were to buy a condo in the mountains by the beach, whatever, and you are going to rent that out on VRBO, on Airbnb, on one of these short-term rental sites, potentially forever, potentially just 1 year to harvest the tax advantages. What would that look like from a cost segregation study for somebody that can't be a real estate professional?
Yeah. So from my point of view, I'm the guy that counts light bulbs. So that's what I do. I'm literally going in and I'm measuring the carpet. I'm measuring the driveway. I'm telling you, how much your roof coverings are. So the active versus passive income, or the active, it's when you're looking at short-term rentals or any other property, we're talking about, cabins or, mountain homes or beach homes. I do studies all across the US. I just did a bunch up in the Blue Ridge Mountains. I was talking at same trip when I was doing the restaurant up there. I've got some properties here in Florida up in Clearwater, St. Pete area that I'm doing right now. And they're homes on the beach that clients went in and they're doing the Airbnb. So they're going in and we're looking at all of the site improvements, just like I talked about, your driveways, your landscaping, your swimming pool, your fences, pickleball courts, whatever it is. And then we're looking at the interior and we're looking at your flooring covers, your window treatments, your decorative lighting, the furniture that you have in there, any equipment. We're pulling forward all of that into year one. So, and the numbers vary. I mean, it doesn't have to be a, multi-million dollar property, but it could be, or it could be, several $100,000 and you're still doing the Airbnb on it. You can accelerate that depreciation. And if you're materially participating, you pass those tests because there are going to be requirements. You can't just go in as a total passive investor and try to write it off. You're going to have to participate in that business. Then you could possibly offset your active income with it. So, and if we use that 20%, let's say, estimate on $1 million property that you're buying on the beach, in $200,000 that you're offsetting. So what would you do with that $200,000 in savings? Most clients will go buy another property. So every year they're coming back to me for another cost segregation study and they're pushing it forward. So one of the takeaways is you would not want to do a cost segregation study on a property that you're planning on selling within a couple of years because you are pulling forward all of those short life assets. You're taking that depreciation, you would get hit with depreciation recapture. So you would really have to understand your disposition of the asset at the time you acquire it. So you really want to know what's my long-term goal before you buy the property. That way you can understand how it's going to impact you and just have a strategy in place so that when you do go to sell it, you know that you're going to do a 1031 exchange and roll it over into another property, or you're going to sell it, pay the taxes, buy a property, and then do another cost segregation study to, kind of push that burden or tax burden off. So it's just really understanding what you're going to do, or you're going to push it forward into your estate. So when you pass, your heirs then get it as a step-up basis, and all that past depreciation just gets washed away. So these are a little bit more, I don't know, I'd say, issues that you would want to explore and really talk to your CPA about. But, that's the key. Just, run the numbers ahead of time, really understand the way you're going to do it, and then, just execute on the plan.
Yeah, no, 100%. A friend in our mastermind, him and his son are doing a property right now. Yeah, and it's amazing. And I'm not a CPA, as I've said many times, but my understanding is, talking to CPAs and reading about it, to qualify, they have to have at least 100 hours of material participation that year, and also have to be the majority of hours, meaning you can't have a property manager that's doing more managing than you. But say that beach condo in Florida for $500,000, for $1 million, whatever, you purchase that, you actively put a bed and couch and whatever TV in there so you could rent it. You rent it as a short-term rental. You list it on Airbnb or VRBO. You rent it, and even if you rented it to a friend or family member, as long as it was rented in that year where you put it into service, you can then do the cost segregation study, get the bonus appreciation, and harvest that tax benefit. Where in that scenario, 20%, where you could be $200,000 of $1 million property, you can garnish that benefit year one, fully potentially eliminate your tax burden or really reduce your tax burden. And you could do that year after year after year. That's been my strategy. My goal is to try and at least buy one property every single year. And I plan on keeping them as long-term holds. The goal is to never sell, at least no time soon, so that I can leverage those benefits, pass it on to my heirs. And even when I pass away, they will be able to what's the word where it's the
They're
value,
taking the step-up basis.
the step up
Yep.
basis. Right. So essentially all those benefits, it's not like you're leaving to your heirs. They just get reset. And
So there's a couple of things that you covered there. So the first one was the material participation test. And that is something that you'll definitely want to talk to a CPA about. Make sure that that not only that you can do it, but you are going to do it. So you're really going to do it. And
Yes.
then you know exactly what you need to document, just like, if you're tracking miles or any other expenses at your current business. The other point that you touched on is the condos. Condos are a little bit unique when it comes to cost segregation. There's a misconception in the real estate world. Agents always talk about you own the airspace where the condo is. So you own the in walls, and the insurance guys will give you an in walls policy to cover all of your contents. But really, you own undivided fractional ownership of the entire building itself, the land that it sits on, and all the site improvements. So when we're doing cost segregation studies, we do our best to pull forward as much of the common area items as possible, but it is difficult to get it to an exact science. So when you're looking at the types of assets that you're looking to buy, certainly standalone buildings are, it's more black and white what you actually own. And then also the percentages. One of the misconceptions that I face all the time is clients will come to me and say, "Hey, I was listening to a podcast, or I was talking to this person and they said I could accelerate 30% or 40% of the asset." And you really have to look at the individual property that you're buying to see what you're buying. So, what the IRS is allowing you to accelerate is short life assets. So, if you're buying a row home in Philadelphia that is literally zero lot line, it's built on the entire lot, you don't have any site improvements. The sidewalk belongs to the county. You're not depreciating that asset, so there's no site improvements. So look for properties that have site improvements: swimming pools, driveways, landscaping, fencing, items that we know are short life assets, 15-year property per the IRS publications. Same thing when you're looking at the interior of a property. If you buy whether it's a condo or a single family home, and it has all tile flooring, or you're planning on replacing the flooring and putting in tile flooring, well, the IRS considers tile flooring as a straight line depreciation item. It's non-removable. But what is removable in most cases is your floating LVP, your carpet. So look at the assets that you're buying. When clients say, I heard that I could accelerate 30 or 40% of the property, I'm like, well, did you actually look at the property? Because, you have to think that, a majority of that is still going to be your structural components, your slab, your building walls, your windows, your roof, your HVAC, your hot water tank. All of that's, 27 and a half year, 39-year assets. So you really have to, I would say, if you're looking at acquiring property for this purpose, really look at the property in its entirety and understand the assets that it has when you're buying it.
Yeah, no, that makes a lot of sense. Well, and another thing that, and even for me, I've looked into this a lot more. A lot of times you think, well, to buy a short-term rental, it's got to be on the beach, it's got to be in the Smoky Mountains or some vacation destination, which a lot of them are, and thank goodness they are, because they're great to stay in. But you can have a short-term rental in your hometown that's down the road from a hospital, or where you've got construction workers or traveling nurses or whatever that might need to rent something on Airbnb, and it's just a regular single family home that they're going to rent for 5 days, for 2 days, for whatever. It could be longer as well, but for the short-term rental in particular, under that 7-day mark, where you could buy a property, rent it on Airbnb, where you're actively receiving those emails when they say, "Hey, do you have a blender in the house?" "Yeah, I do," or "I know I don't," whatever. You're responding to those questions. You get it rented, and if it makes sense, as a short-term rental, you could keep doing that short-term rental for years and years to come. If you buy it in 2025, you put in the service, you rent it a couple times, but it just wasn't real profitable in your area, and you'd rather convert that to or for a long-term rental in 2026 or 2027, that's a possibility, correct? That you could put it into service as a short-term rental. You do everything, talk to your CPA, do all the steps that you would need to make sure it is a short-term rental, and to hit all the qualifications. And assuming it makes sense, you may want to keep it as a short-term rental for at least indefinitely. But say it didn't make sense for you and you wanted to convert it, I'm assuming that's something that could be done, correct?
Yeah, I mean, you'd want to definitely make sure that you're checking the zoning, local zoning codes regarding short-term rentals, making sure that the property, and that's a big one, is you never want to buy a property just for the depreciation. You want to make sure that it's a performing asset, and I've seen clients rush into transactions just because it's getting towards the end of the year. They knew they have a tax burden coming up. So they're searching for a property, and you just want to make sure you're getting a good deal and you're able to use it for the purpose that you're acquiring it. But you're absolutely right as far as the depreciation goes. The way that you're taking it's going to be based on use. So if you have a short-term rental that then you convert to a long-term rental, we would just update your depreciation schedule from a 20 or a 39-year asset to a 27.5-year asset. So you'd update that when you make the change. You would just want to make sure that your intentions were to, rent it, for its intended use.
Sure. No, that makes sense. So yeah, no, that's a powerful strategy. Another one is the real estate professional status, and that's where my wife's been a real estate professional for years. We've got multiple rental properties, both residential and commercial, and she does actively participate in that. She does plenty of work to help manage those and take care of them. But you also don't need to be a real estate professional, meaning you don't have to have a real estate license. You don't have to work for Century 21 or Remax or one of these realtors, but you could still be considered a real estate professional if you meet the qualifications. And again, this is one, talk to your CPA, see if your spouse could qualify. Say you're the active dentist, it would be very difficult, if not impossible, to show that you are also a real estate professional, because they're going to see what's your primary job, your primary income coming from. And if it's coming from your dental practice, then that's a hard stretch. But your spouse may be in a different situation where he or she could qualify as a real estate professional if they're putting in the 750 hours a year, materially participating, working in that's another option that you could qualify to unlock the bonus depreciation cost segregation to help offset active income.
Yeah. So what you're talking about there is the real estate professional status. And, the reps status really does allow individuals to take all of a sudden residential property and treat it just like you would your dental practice or a hotel or a restaurant or a food truck or anything else. It's part of your overall business. So if you're in the real property business, meaning you're a real estate agent, a real estate broker, you're a property manager, you just own a lot of property and that's your full-time job, then all of a sudden you can take the depreciation that residential rental property, long-term rental, so anything greater than 30 days, now can offset the income that you're generating from your business activity, which is a real estate business. It doesn't mean you're a broker or an agent, just like you said. You could be a builder. You just have to make sure that, you're putting in the hours, and then you could group your income activity and offset other active income. So that's what you're talking about, is having a spouse's losses from real estate. And we're not talking about losses from the income they're generating. We're talking about the losses from the depreciation. So a paper loss is offsetting taxable income. So that's the reps benefit. It's a really big advantage of being a real estate professional. But you're right. If you're a dentist, it wouldn't work because your primary role is as a dentist. Now, if you were you're stepping back from your career and you're working less than 50% of your time as a dentist, and you're focusing more of your time in real estate, then all of a sudden you're probably going to meet that 50% part of the test, and it would offset your dental income. Or let's say you're no longer a dentist because you've retired and you're looking for additional things to do, then being a real estate professional would be a great choice if you have that extra, let's say, assets that you could purchase property with.
Yeah, no, great point. Another question, I think I know the answer, but just for the podcast, say somebody would like to do a cost segregation study on their dental building that they own, but they're worried, well, it might get audited, and if I was to get audited, would the cost segregation individual or person that did this cost segregation study, would they stand behind me and be behind the report if I was to be audited? How would you respond to something like that?
So audits do happen all the time. I mean, they're not super common, but they do happen. I would also say there's red flags that will trigger audits. It's not always the cost segregation study that triggers it, but if you're in an audit, they'll probably look at everything, including the cost segregation study. So the first thing that you're going to want to do is look at the type of study you're doing. So some providers offer modeling studies where they're just doing a model approach. That's not something that you'd want to do unless you have a valid statistical sample set, which you're probably not going to have unless you're building, a dozen homes and you've done a cost segregation study on at least one of them, because we're talking about statistical sampling at that point. So you'd want a detailed engineering study where you could actually look at the study. The auditor or at the IRS, the agent, they'll ask for it. And what they're looking for is, can I pull out individual component cost? So you're going to look at the total basis of the building, carve out the land allocation. You're going to want to make sure that your land allocation is a reasonable land allocation for the area that you're in, and you're not just using a rule of thumb method. And then once you have the basis, you're going to look at the individual components and does it make sense that, you applied this dollar value to that specific asset? And if you can show the IRS agent that it does and it's reasonable, then I don't think you have much to worry about when you're doing the cost segregation study. I would say that you would want to make sure that you're not going with let's call it a provider that's aggressive. I'm not a big fan of companies that say, we'll get you the maximum amount of accelerated depreciation, because if they're broadcasting that and advertising it, it's just, it's like, okay, what did they do to stretch those numbers to really push them up? And if you're in an audit, the agent's going to look at that too. Okay, well, let's see, did you really spend $10,000 for that refrigerator? Probably not. Well, maybe. I mean, I've seen some very expensive refrigerators, but if you're looking at a residential property, whether it's a short-term rental or not, if they come back and your appliances have some inflated number, that means they just did the study wrong, and the auditor's going to know that too. So I would say just be careful when you're talking to providers. Get estimates up front. Don't push for the absolute maximum accelerated depreciation, because you're not going to be audited the year that you file your tax return. You're going to get a call in 3 years when you're, down the road doing something else. And so just really look at it. Also understand the person that you're talking to. Find out who you're talking to, really what their role is with the company. Are they going to be someone that you can talk to down the road year after year? So I would just say, have the conversation. And if you are working with the company that is strictly online, pick up the phone, call the person, see if you can talk to them, just like any other professional. If you can't get your CPA on the phone at least a couple of times a year, if you can't get your cost segregation provider on the phone, it's like, you just want to be able to talk to the folks that are doing the work.
Yeah, that's a good sign. You might need a new cost seg expert or new CPA. I 100% agree. And on that note, I've worked with Brian for years. You have been amazing, answering questions, looking at different properties that we were considering investing in. And it's such a relief to have somebody that knows what they're doing, where I'm not concerned. I mean, I know if I get audited, it's legitimate, it's legal. And I've even know real estate investors that they do their own cost seg. They're not a CPA, they're not anything. And they just kind of estimate some numbers and throw together a cost seg. I'm like, that is so stupid.
That's one of the red flags that we see in the IRS sees too. I've assisted with a couple of audits this year, and that's exactly what happened. And they didn't have the specific data to back up the numbers that they provided. They were using, again, it was a statistical sample set based on an assumption. And that is not like, that'd be like saying, well, I assumed I made, dollars this year. They're like, well, show me where, it's like, show me your books. I really want to see the numbers. And that's what they're going to ask for. They're going to ask for the mileage log. They're going to want to see the numbers.
Yeah. 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 No, it makes sense. Well, and at least with your firm, you guys are very reasonably priced. I know residential is cheaper than commercial, because commercial is more complex, but still very reasonably priced. It's pennies compared to what you're saving, it's just unbelievable the difference. So it's definitely something to invest in,
Yeah,
where you're
just
going
get
to get
the
a great return.
estimated benefit. It's free. It's a bit of heavy lifting on our side because we are pulling the property tax records. We're going online. We're looking at the property. We're really trying to generate an estimate that is realistic. But, if you're not in any big rush, meaning you're not filing your taxes tomorrow, it's worth getting the estimate. It's worth contacting your CPA, making a decision, and then moving forward with it. It's not like I don't know. It's not something that you're buying today. It takes a
Hmm.
little bit of work to get through the process, and it shouldn't be a rush. I got a client yesterday asking like, "Hey, how fast can you do the study?" I'm like, "Well, we're no longer in tax season, so we can do the study quickly. If you need it next week, we could probably get it done for you. It's typically about 2 to 4 weeks after we have all the documents in, uh, unless you need it for some specific reason, meaning you haven't filed this year's taxes and you're getting hit with a penalty. But yeah, it's just one of those things that really take your time with it. Talk to all your advisors and then move forward.
That makes sense. And that's a good point too, that say somebody bought a property in 2024 or in 2025, they could still file afterward. Let's say I bought one in 2025 and plan on, when I file my taxes in April, or I extend it, whatever. I'm assuming you could do a cost seg. I bought the property in 2025. You could do the cost seg in January, February of 2026, but still apply it for that 2025 property before you file your taxes. Is that correct?
You just have to have it done prior to filing your tax
Before you
returns.
file. Got it. That's awesome.
So
That's
you
awesome.
you don't have to do it in tax year 2025. It could be done. The actual study could be done in, tax year 2026. You just have to really pay attention to everybody's timeline, because if you wait too long, everybody's getting buried, because,
Yeah.
you're going to have to get the site inspection done. The cost segregation studies going to have to be completed. Your CPA is going to need to review it, and then they're going to have to file. And you
Hmm.
don't want to, just wait to the last minute. I would say, I always tell clients, just, even before you buy the property, shoot over, the property that you're thinking about buying. I'll work up the estimate. That way it's part of your workflow. Once you close on it, just know that, you can order the cost segregation study anytime, but just give yourself a window to file your returns. And I also have clients that say, "Hey, well, I'm planning on doing upgrades to the property the tax year that I bought it." I'd say, "Well, perfect. Let's have that conversation too." Because what you don't want to do is buy a property, go in and rip out all the assets, throw them away, and never place them in service because you just threw away all the property. So you can't dispose of an asset and take depreciation on it. So if you buy a property and it's ready to go, then keep the assets in place. If you're planning on doing a remodel, maybe do it the next tax year. Or, it's based on, what's the real intention, what's the goal, but just pay attention to that. So I would say absolutely have that conversation and know that if you have to update the study because you did it in August, and then all of a sudden, come September, October, you got to replace the roof, just let me know and I'll revise the report and put the new roof into the study. It only takes a few minutes. And that way you're only providing your CPA with the one document. You're not giving them a bunch of receipts.
That's awesome. That's awesome. Brian, this has been amazing. I want to be respectful of your time. If somebody would like to go into this further, they've got a property they'd like to discuss with you, how is the best way for them to get a hold of you?
Best way to reach me is just on the website, costsegrx.com. It has, links to contact me, whether it's, through just a web form. It has my
Hmm.
phone number. It has my email. I'm super easy to get in touch with. You can also schedule a call with me.
Awesome. Thank you so much, Brian. Looking forward to our retreat in Cabo. Brian's going to be presenting as well to our mastermind members, and looking forward to that. Hearing from you, and then having some nice fish tacos. So
There you go. Hey,
thank
thank you very
again,
much.
Brian. My pleasure. Thank you, and look forward to talking to you soon. Take care.
Thank you.